our market. We've identified that we're going to be looking for some breakout opportunities. We do a little bit of sort of back testing of that method over the last 12 months to see what sort of results. You know, everybody wants to know, we talk about breakout. What are some easy breakouts? Are we talking breaks above previous high? Like at what point are you looking for consolidation? Just so someone's got themselves, you know, they can sink their teeth into an actual entry signal.
Simple. You go and buy yourself $1 million ruler. It costs you about 5 cents. In other words, a straight edge trend line is one of the most powerful tools in the market. So if I'm looking for a breakout, I'm looking for a combination of 3 factors. First, I'm looking for a trend that can be defined with a trend line. There's lots of trends out there that can't, we'll use a downtrend, lots of trends out there that can't be defined with a trend line. Okay, I'm not interested in those.
When you say define, just touch the line at least 3 times? Or
at least times. You've got a market that's moving down. And I can define the upper edges of that trend with a straight edge trend line.
And so there's no frame, because
let's go back 6 months. Go back 12 months maybe. But, you know, let's say 6 months for a minute. And it's a clear trend. There's no sudden spikes that are above it and dip below it, and there's not a lot of stuff that's below the trend line. Yeah, it's clear. It's bang. When you see it, you'll see it. And you got to sit there and say,
then it's probably not there.
No, go to another stock. Go to another stock. There's lots of choices out there. Find the stock that gives you the clearest compatibility with the method you want to use, because what that means is that when the exit signal comes, there's no room for provocation. There's no room saying, well, maybe if I just adjust this, it'll be okay. That's what you're looking for. So, number one, do I have a stock that can be defined, the downtrend, with a clear trend line? No arguments about where it ought to be, or it should be up here or down here. It's there. That's where it is. Bang, 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 bang. 4, 5, 6, 7, 8, 10 connect points. No breaks out above it. That's number one. Number two, can that trend also be defined with a GMMA? Guppy multiple moving average. Does it give me a good set of solid, reliable signals? No false breakouts. That's the key factor. If there's been no false breakouts in the last 6 or 8 months from that relationship, then when I get a crossover or a signal that's telling me the GMMA is compressing across multiple time frames, then I know it's have a higher probability of reliability. So that's what I'm looking for. Okay, so I've got number one, the trend line. Number two, GMMA. GMMA, I'm looking maybe at a test, retest, maybe third, fourth test. So when I get price that closes above the trend line, and I've got a GMMA compression relationship across 2 sets of moving averages, 2 time frames, then it increases the probability that trend break is genuine. On top of that, I then want to define that breakout with price volatility. And for that, I use a countback line. You can use something like 2 times 1 times ATR if you want.
I got the countback line from you. It's fantastic, especially in stop loss as well.
That's right. But we're using it here as an entry point. So what we're looking at is that price has to rise by more than its normal volatility. That's essentially what it is. It's a self-adjusting volatility measure. So once it moves above there, there's my entry signal. I've got three things lined up in a row. Now, let's look at those 3 things. What's a trend line do? The trend line defines what's happening purely with price. It's not related to any other calculation. It's purely a chart recognition pattern. Multiple moving average is a technical analysis factor. In other words, it's taking price and it's manipulating the values of price. So it's measuring it in this trend in a different way. And then you've got a countback line, which is measuring volatility based on price. So you've got 3 different measures that are giving you 3 independent conclusions about what's happening with the trend. So when that breakout develops, there's a higher probability that breakout will be successful. Not 100% guaranteed, but a higher probability. There's another stock out here that has pretty similar relationships, but there's a couple of days where it's spiked well above the trend line, or where we've seen a GMMA compression and failure and so on, or the countback line hasn't been successful. Okay, I'm not interested in that stock. I haven't got enough money to trade 1,000 stocks. I've got enough money to trade 1 stock. So part of the process is to find the stock that is most compatible with the techniques that I want to use. That hasn't in the recent past given false breakout signals, given false signals of any description, that it's compatible with all of my approaches. So when I enter it, there's a high probability it will continue to be compatible moving forward.
Do you look at volume as well, or?
Volume is unimportant. Why? All of the stuff that's written on volume really goes back to the 1930s, 1940s. If you take the Wall Street Journal in the 1940s was about the same size as Mill, you've probably got a suburban newspaper somewhere, you know, one of those free advertising things that's about that thick.
Yeah, like Beat magazine or something like that.
Right. That was the Wall Street Journal in the 1940s.
Yeah.
Now, before it went back online, they're looking at weighing more than 2 kilograms. So that tells us that the flow of information has increased exponentially. We know that.
Yeah.
But more importantly, that access to that flow of information has increased dramatically. So all the volume work is really based on the idea that information is restricted, that it's only the large players that really have access to it. So if you look at large volume, it's the large players in operation. Jesse Livermore did it. He always said, look at the volume, because in his day it was the large traders that set the scene on a limited number of stocks. So it's an old-fashioned idea, belongs to old markets. I'm not trading in 1930, I'm trading in 2009. So what happens with volume? You know yourself, you use Metastock, you do all sorts of scans. What are you looking for? What's your basic scan? Price and volume.
Yeah.
And how many other people are doing exactly the same thing?
Probably everyone.
And out of price and volume, what's the most important, price or volume?
Obviously price.
That's right. So you're scanning for price. You're looking, for instance, for all of those stocks that have increased more than 10% today.
Yeah.
And then you'll do a secondary scan for the volume on those stocks. But price is your first thing. So is everybody else. Yeah. They're all doing the same thing. And they see price goes up 10%. It's like a schoolyard fight. You know, how did you know a schoolyard fight was on? Did anyone tell you?
You look for a crowd.
Suddenly, there's the crowd.
Yeah.
So, price is the fight.
Yeah.
So when you find a 10% increase in price, for argument's sake, you can guarantee that there's lots of other people doing exactly the same thing, and tomorrow, they'll be there.
Yeah, okay.
And that's what creates the volume. So what happens now, and that's the most important change in this particular discussion that's taken place between, let's say, 1930 and 2009. In 1930, price followed volume. In the 21st century, volume follows price.
Yeah.
It's a major change in what happens in markets. So price becomes important, volume becomes important only in terms of, can we get into this trade? I want to trade at this size.
Yeah.
Okay, the market's not deep enough for me to be able to do that. So I've got a choice. Do I reduce my trading size, or do I look for another stock?
Yeah.